Good afternoon, everyone. This is Laura Labanier Campbell with CalTRUST, and I'd like to thank you for joining us for today's webinar on the fundamentals and nuances of net asset value. This webinar is actually a continuation of a two-part white paper that we released last fall focusing on the great debate of floating versus a fixed NAV. For reference, the white paper is available on the resources section of the CalTRUST website. Our speakers today are Jeff Weaver, Head of Short-Term Duration Separate Accounts for CalTRUST Investment Advisor Wells Capital Management, and Kip Meadows, CEO of CalTRUST Fund Accountants Nottingham Company. If you have any questions during this presentation, please type them in the questions box on your GoToWebinar control panel, and we will answer them all at the end of the presentation during a Q&A period. Jeff, if you're ready, please go ahead and take it away.
All right, great. Thank you very much, and thank you all for attending. As Laura said, my name is Jeff Weaver, and I'm Head of Short Duration Fixed Income here at Wells Capital. Today we are going to discuss NAV. We're going to discuss the benefits of unitized funds and the role that NAV plays in total return. Kip Meadows is going to take the lead on those topics, as it is his firm, Nottingham Investment Advisors, that, among other things, strikes the daily NAV for the CalTRUST funds. I will then follow up with a discussion on the primary drivers of NAV volatility, provide an update on money market fund reform, and also provide a summary of current portfolio strategy in the CalTRUST accounts. So at this point, I guess take it away, Kip.
Okay, thanks. Laura, I think maybe the next slide. Okay. This is Kip Meadows from Nottingham. Nice to be with you from the other coast. Try to my best to make a somewhat dry topic interesting and bring it back to what we're doing for the CalTRUST portfolio and how it might also benefit some other accounts that you're working with. Thought I'd just give an overview of net asset value accounting, what it really means. I'm sure most of you, if not all of you, own mutual funds in one form or another, either personally or in investment accounts that you manage, or both. A net asset value is just a unitized valuation of, like a mutual fund. It's made up of the underlying principal, total asset value of the account, and it also keeps on a unitized basis the income accrued on a per share basis, called undistributed net income. We'll talk about that in a minute. And we'll also keep segregated the realized and unrealized gains on a unit basis. In essence, what you do is you have a number of shares in the account as shareholders enter and exit an investment portfolio. And of course, you have the total assets, and you just divide the total assets by the number of shares, and that's the net asset value. On a daily basis, you'll mark the account to market, so you value each of the underlying securities at their then market value. What we typically do on almost all accounts is at 4 o'clock Eastern Time, the close of the New York Stock Exchange, and update the value of all the securities. In the case of CalTRUST, is the fixed income securities. Also, during that day, you will apply the accrued income. That's accrued whatever the accrual method is for the bond that's in the portfolio, actual over 365 or whatever it might be, actual over 360. Each security type has its own accrual methodology. So you will come up with the accrued income for the day and add that in. If there are any expenses that are deducted, that's a typical accrual as well, and that's on a annualized accrual divided by 365, so you get the daily accrual. So then at the end of the day, you come up with a net asset value. The value of it, it has a lot to do with the type of accounting used during the month. There are really two different types. Trust accounting typically takes the beginning balance plus and minus transactions to come up with the ending balance. And most trust accounting platforms do that on a monthly basis because that's really the only need that they have to do that. The problem is if you have any inflows or outflows from the portfolio during the month, you cannot accurately allocate either the capital gain portion of the portfolio, say on the 13th day of the month or the 17th day or whatever it might be, and the income also would be estimated. Even the only way that it would be accurate, it would be if there were no transactions during the month other than the one transaction you're talking about, because every time you have a transaction in or out, it increases or decreases the number of shares outstanding. So the unitized accounting or net asset value accounting has the primary benefit of very, very accurately being able to track the underlying value of each account. So if you have an account where you're pooling multiple shareholders, like CalTRUST or like any mutual fund, everybody wants to know that they're getting what they're entitled to, no more or no less. Of course, it'd be nice to get more, but it's not fair. So that's really the value of it. So the accuracy of the ownership interest is really the primary benefit. And that's why all mutual funds, investment companies, or accounts that mimic investment companies use unitized accounting. The CalTRUST portfolios really are designed to mimic short-term fixed income funds or money market funds in case of stable net asset value funds, so that entries and exits can be made on a daily basis, and everybody knows that the accrued income that they're receiving, if they put their money in on the 13th and it's 30 days of the month, that you're getting 17 days worth of interest accrual for your account, and that if you exit on the 20th day of the month, you know that you're getting those first 20 days of interest accrual properly applied to your account, and everybody knows that they're getting what's fair and allocable to their account. I think I've covered most of that, Laura. What's on the next page? Kind of talked about this a little bit, but I'll go into it in a little bit more detail. The principal value of the portfolio is obviously the underlying securities in the portfolio. So as I gave an example before, you just mark to market the underlying securities and come up with the total assets of the portfolio. And if all you were interested in was the principal NAV, you would divide that by the number of shares. The interest income is typically, and in the case of the CalTRUST portfolios, is paid out at the end of the month. So during the month, on the first day of the month, you start out with zero, and then at the end of the first business day, you will have a component of the net asset value that's equal to the accrued income for that day. Then that accumulates and is tracked on a per share basis, second business day and third and on through the last business day of the month. And by doing that, you have a unitized on a per share or per unit basis, you have the income that's attributable to the account. So on the 30th or 31st day of the month, the last business day, you know exactly what income is attributable to each shareholder. That also holds if the shareholder, the participant, has entries and exits during the month, because the accruals are really tracked on a cumulative basis and applied to each account on a daily basis. So if you start out with 100,000 in the account, draw it down to 80, put 50 in it, so you have 130 for 10 days, and go back to 110 the last few business days of the month, the income that's attributable to your shares will track those entries and exits on a per share basis, on a cumulative basis. So it really is the best way to, on a highly accurate basis, divide the principal and the income among the shareholders, so everybody gets what they're entitled to and knows that they're not subsidizing somebody else's account. So I can't think of anything else I think that might do it. Jeff, I think I'll hand it back to you.
Excellent, thank you. I think one of the things too that when we speak with our CalTRUST clients is that they're certainly aware of their NAV and the changes in NAV, but it is important too that over time your total return is change in NAV plus the income that you have earned over that time, and that ends up being your total return. So it's always important for investors that are concerned with preservation of principal, which we in short-term fixed income markets are. It's certainly one of our top objectives. You have to look at the two together. On slide 5, I thought I'd go into some of the drivers of NAV volatility in bond funds. And the largest driver in daily volatility for the NAV of a bond fund is interest rate risk. And of course, interest rate risk is quantified by a term known as duration. We all know that as interest rates rise, the market value of a bond decreases, and conversely, as interest rates fall, the market value of a bond increases. The same can be said for bond funds, and so NAV is that price, and the measure of a bond's interest rate sensitivity is duration. So specifically, duration is the percentage change in price due to a unit change in yield. The longer the maturity of a fixed rate bond, the longer the duration, and the greater price volatility. Again, for a bond fund, NAV is the price. So the longer average duration of the bonds held in a fund, the longer duration of the fund, the greater the volatility in NAV. Of course, when you invest in bond funds that have longer durations, you're typically compensated by a greater income. So, at the end of the year, you may have experienced greater price volatility, but you've also been paid for that, compensated for that in terms of a greater income. In the recent bond sell-off that we've seen, really in the month of June, of course that sell-off was sparked by comments made by the FOMC regarding the tapering of QE3 purchases. We've seen bond fund NAVs generally decline, and of course, the longer the bond fund, the greater the decline. Now, I think another thing that's very important or one of the other important drivers of NAV volatility is credit risk as well. In a moment, we'll reference a little bit the situation that occurred with the reserve primary fund or the reserve money market fund, but that was a case where a one-off security, Lehman, caused a break of the NAV from $1, and so that was that one-off credit risk, that one-off name-specific incident that caused the NAV to drop. Conversely, or in addition, you could also see corporate bonds underperform as an asset class. And so one of the things that we've seen in June, although corporate bonds have been tremendous performers over the last couple of years, corporate yields have increased greater than Treasury yields, thus some underperformance. So bond funds over the last month, we've seen NAVs drop modestly, and it's been a function of not only rates going up, but also how much exposure those funds had to corporate bonds as they underperformed at the margin. On the next page slide, page 6, we go through a scenario analysis. This is an analysis in which we shock a portfolio to a change in interest rates, both up and down, in order to illustrate the resulting effect on total return. So on page 6 here, we actually have the CalTRUST short-term fund. It has a duration of 0.79. It has an initial NAV of 10.01 as of June 30, a reinvestment rate of 51 basis points gross of fees, and we're going to, in this example, we're going to assume $1 million initial investment. So column 1 there, if you will, the yield change, denotes a change in yield. So minus 50 is minus 50 basis points in yield. Of course, 150 is plus 150 basis points in yield. This is over a time horizon of 12 months. So in the second column, total return, you can see we've highlighted one of the rows there, 75. So when yields are up 75 basis points, the fund has an approximate return of 0.12%. Income return went up from where we were before of 72 basis points, but it had negative price return of 0.6%. On the far right-hand side, you see a change in NAV. You also see a change in market value. So the point with this fund is although the NAV has dropped from 1001 to 995 over this 12-month period, because of the income received, you can see that you still have a positive total return and no principal loss. So at the end of this 12 months, you would have $1 million, $1,220. So just an example of the type of volatility that you would see in this short-term portfolio that has a duration of 0.79. One of the things I think that's important as well is, although interest rates are higher over the year, with 10-year yields are over 70 basis points higher. I think as I walked in here today, the 10-year note yielded 2.49%, right around 2.5%. The short end of the market has been much less volatile, and so 2-year notes, for example, are only up 5 basis points on the year. Right now, the 2-year notes are around 30 basis points in yield. So that's a trend that we would expect to happen, although the broader trend in interest rates is for rates to go up. We don't expect short-term rates to go up until the Fed is actually ready to raise the Fed funds target rate. And so a couple months in advance of that, the market will begin to price 2-year notes, anticipating an increase in the Fed funds target rate. However, we don't expect that to occur until the year 2015. Of course, right now they're talking about starting the tapering process in September, anywhere between September and December, the end of this year, to start taking away the easy monetary policy that has been in place, and that they would finish that tapering by the middle of 2014. And then at that point, if were they still to feel the need to remove economic stimulus by tightening monetary policy, at that point they would start to raise the Fed funds rate. So I think we have some time before we see short-term rates go up significantly. On slide 7, we have the example of the medium-term CalTRUST medium-term fund. Of course, in the medium-term fund, this has a 1.89 duration. One does earn greater yield. That's what entices investments in this fund. However, you have to be cautious and knowledgeable about the potential for NAV volatility. So in this example, as of June 30, the NAV was 10.03. We have initial investment of $1 million, and rates need to go up almost 50 basis points before that $1 million becomes something less than $1 million. So on the previous page there, on the short term, of course, you had to go up greater than 75 basis points, almost 100 basis points before you would see a negative return. Here, rates can go up by just less than 50 basis points before you see a negative total return. So it's important to know when you're investing in these funds. Again, you are taking a little more interest rate risk, a little more credit risk by moving further out the curve from the short-term fund to the medium-term fund, which in times when there's stable or declining or even just modestly increasing rates, you will you'll benefit from greater returns. However, again, in a period where rates go up, one needs to be a little more cautious by owning the medium-term fund. And I think again, the medium-term fund is largely invested in securities that are 3 years and less. So goes a little longer than the short-term fund, but we do expect particular short-term rates 2 years and under to stay fairly low here over the next year or so. One of the great topics that's out there right now is money market reform, and of course, much has been made about this since the financial crisis of 2008, 2009. One of the lowlights of the crisis, of course, was the breaking of the buck of the reserve primary money market fund. And this is a $65 billion account or fund that owned $785 million worth of Lehman debt, and it broke the buck. Of course, the 2A7 money market fund land has historically been a dollar in, dollar out, stable $1 NAV, and now there's a lot of discussion about reform in order to make these funds less susceptible to runs that could harm investors. So it was certainly one of the bigger concerns during the crisis. Money market funds have a status of being systemically important, and so they want to make sure that there's not a panic around or a run around money market funds. So just recently, on June 5th, there was 2 reform proposals for comment that were provided by the SEC. Right now, we're in a period we're in a comment period, and the final proposal is expected to be released in the first quarter of 2014 or shortly thereafter. Of course, this is the second iteration of this. I think we were expecting to have some answers at the end of last year, and it was put off until this year. But the summary of the proposals that came out on June 5th were, one, a suggestion to move from a fixed or stable dollar NAV to a floating NAV. And we were just talking about how those NAVs can change. Of course, with money market funds so short, you could argue that even if you went to a floating rate NAV, there wouldn't be much change. And of course, in a normal environment, there wouldn't be much change. However, in the case of like the reserve, at the end of the day, when people ultimately got their money, investors ultimately got their money back, they received about 99 cents, just over 99 cents on the dollar. So this is one of the proposals that's been out there. If this were to take place, we wouldn't expect any changes made until 2016. And I think it's one of the things that certainly is on people's minds. I think both investors and fund managers are wrapping their heads around this, and there's a lot of things that need to be sorted out, such as accounting methodologies and taxes, etc., for investors. But one of the drawbacks to floating NAVs is if the NAV began to fall in a money market fund, would that actually stem a run on that money market fund? And so one of the things that have additionally been added to this proposal that was different from last year is a couple things that are referred to as liquidity fees and redemption gates. And so I think it's important that both the floating NAV and the liquidity fee and the redemption gates has really been, I'm sorry, I'm going to back up. For the floating NAVs, that's really just for prime institutional funds. So government funds would be, government and retail funds would be exempt. However, for liquidity fees and redemption gates, these would apply to all prime funds, both retail and institutional classes. When we speak of liquidity fees, there's that defined as there would be a 2%, what they've proposed is a 2% fee for all redemptions of a 2a7 money market fund during times of stress. And stress is being defined as weekly liquid assets falling below 15% for a fund. So one of the things that's unique there is you can imagine many investors watching the daily update of the the measurement of the weekly liquid assets. So as that is being used to measure a time of stress. Redemption gates are referred to as a scenario in which the mutual fund board, at their discretion, during times of stress, could actually put on a temporary redemption suspension. So over the next 30 days, no redemptions can be made out of this fund. And so those are some pretty big, those are some pretty big thoughts that investors need to wrap their minds around. And right now, it's possible that we get both of these. I think it's the 5 non-voting members that were polled about these 2 proposals, and 2 of them favored both. 2 of them were didn't voice their opinion, and 1 just favored the liquidity fees and redemption gates. So it'll be interesting to see how that evolves. We believe that that if liquidity fees and redemption gates were put into place, it could happen as early as 2015. So still some time before we get there. With regard to additional disclosures and diversification requirements, the additional disclosures that we are speaking of, or that they are alluding to, would be including daily website disclosure on a mark-to-market based NAV or a floating NAV, so daily disclosure of that. Many funds are already doing that in the form of a shadow NAV. There would also be a daily disclosure of the current daily and weekly liquidity measures. As per SEC Rule 2a7, which governs money market funds, funds are required to have daily liquidity of 10% of the fund's market value, and weekly liquidity of 30% of the fund's market value. So, and then of course we talked about a time of stress being defined as weekly assets being falling below 15%. Also to be disclosed would be net investor flows. So investors could see whether there's been net purchases or net redemptions in a particular fund. So one can imagine where investors might pay particularly close attention to these were some of these proposals to be accepted. From an additional diversification standpoint, there's a number of rules within 2a7 that would be made more restrictive, including an aggregation of affiliated investors for 5% concentration limits. Right now in 2a7 there's a 25% basket, typically an overnight investment that's not subject to 5% concentration limits. That would be eliminated. And then also they're proposing an aggregation of all asset-backed security vehicles for a 10% guarantor limit. So some increased diversification as well.
Jeff, can I add one thing?
Yeah, absolutely, Kip.
I think a lot of this is largely theoretical, and I'll tell you why. Because money market funds are limited to a very short duration, 90-day average duration or less in the securities underlying. And GAAP accounting gives, from an investment accounting standpoint on fixed income securities, any securities that are less than 13 months may be amortized or accreted from purchase value to maturity value. And that's to make the daily accrual of the income even over the period to maturity. So the only time you would have a situation where a security would fall outside of the guidelines and you'd have to price it on an individual basis, price that individual security, or if it was investment grade and AA or better, and in less than 13 months, you expected that company, the issuer of the debt, to go into default. Now, that did happen with Lehman, because Lehman very fraudulently issued securities, and the debt rating agencies didn't pick up on what was going on, and so they had a high investment grade rating, and the debt they were issuing was worthless. And it certainly could happen again, but because of that situation, it's much less likely. And you're talking about securities that had to be investment grade when they were purchased, and 90-day to maturity, and so I think it's very, very highly theoretical that could ever come into play, and a lot of money has been spent on something that is more theory than anything else.
Certainly, some of these reforms are quite controversial, particularly the way we've been accustomed to doing. I think investors in general, from the way we've been doing it, they're probably reluctant to change. They like the stable NAV of these funds. As managers, fund managers, they want their clients to be happy with their investments, and happy with the type of conduit they have to invest in those. But I think at the same time, I think it's money fund reforms probably not going away, and perhaps Kip, in your example, that hey, these are dollar NAV, perhaps that's when that's why they propose these liquidity fees and redemption gates, in order to stem the run on any panic run on funds. So it'll be interesting to see, and again, it will certainly take some time. It's tough to handicap what will actually occur, but I think one thing is for sure is that it'll continue to be on the spotlight, and some changes will come down the road, in conclusion of this. So I think that's where.
If I can state what I was trying to say, I might not have stated it very, very well, but kind of an adjunct to that is, even if they do go to floating rate NAV, if it's a 2A7 fund, the likelihood that it would actually float is very, very remote. If it was a dollar NAV, it would the likelihood of it remaining at $1 would be 99.9 out to a lot.
Yes.
And if I were an issuer, I wouldn't get into the liquidity fees and other things, and it's just not going to come into play. But that's
well said. Well said. So finally, as strategy relates to the CalTRUST funds, of course, within CalTRUST, there's 3 current options. There's a money market fund, which is a prime money market fund. There is a short-term fund, which typically has a duration of around 0.5 to 1.0, and then there's a medium-term fund, which typically has a duration of 1.5 to 2. The money market fund is there for more day-to-day transactions, day-to-day liquidity needs. As you get comfortable with your liquidity needs, and one feels that they can take a little more risk, the natural extension is to go to the short-term fund. This fund is very competitive with LAIF, and then the medium-term fund is for monies that might be core cash, where there's no immediate needs, and certainly from a liquidity standpoint, you'll be more of a long-term investment, something where you're not going to need the liquidity in those funds. So currently in the money market fund, this fund is being run shorter than comparable money market funds. It has a weighted average maturity of 31 days. There is a tremendous emphasis on liquidity. Again, I mentioned that daily liquidity from a 2A7 standpoint is required to be at 10%, and weekly liquidity is required to be at 30%. The fund, in fact, right now is at 26% on a daily basis and 44% on a weekly basis. So this is much higher than industry standard. On the short-term fund, current duration is right around 0.75. We do like yield advantage sectors, particularly corporate bonds. Of course, corporate bonds are capped at 30% per California code, we also invest in agency debentures, asset-backed securities, and municipals. We like the yield advantage right now in the corporate bond sector. We do favor financials over non-financials because of increased regulation resulting in stronger balance sheets. There's also a lack of leveraging events in the financial space versus their non-financial brethren, such as a perfect example there is Dell, where investors are taking, and the owner of the firm are actually taking the company private and leveraging the company up, making it a non-investment grade credit. And of course, we like the additional yield of corporate bonds as well. And I think when you combine, our desire to hold corporate bonds for their yield, I think we also have a great benefit in working with our credit staff and picking bonds that we, one corporate credit versus the other. In asset-backed securities, we do like securities backed by credit card and auto in the auto sectors. In general, credit card and auto loan defaults and delinquencies are at all-time lows. Credit card prepayments are high, which is an indication of consumer strength. And in autos, we particularly like auto lease deals, which are being supported by high residual values and strong used car prices. One of the sectors that we've increased over time in both the short-term and medium-term fund over the last couple years is increased exposure to municipal securities. Municipals are inherently less volatile than their corporate brethren. Historical default and recovery studies favor municipals when comparing municipal bonds to corporate bonds. Currently, right now, we're seeing some strength in revenues. Revenues are increasing at both state and local levels in the form of income and sales taxes. Also, expenditures are down as a whole as well. And so municipals is certainly a sector where, again, one needs to do its credit work to understand the uniqueness of each credit. But we at Wells Capital are quite comfortable with and proud of our municipal and corporate credit resources and helping us pick bonds that are going to most benefit our investors. I think one of the things that's important with the short-term fund is that very few securities are owned that have maturities of greater than 2 years. So again, this guards one against a potential steepening in the yield curve. What we witnessed when Chairman Bernanke started speaking of tapering of purchases is a tremendous steepening of the yield curve. So by staying in securities short of 2 years, you can really insulate yourself from those from that steepening. Also, when you look at the medium-term fund, of course, CalCode allows one to go out to 5 years. We hold very few securities that are fixed rate bonds beyond 3 years. So again, insulating ourselves from potential steepening. And at the same time, in both those funds, really maximizing exposure to corporate bonds and to a lesser extent munis and ABS, asset-backed securities. So, with that, that's the prepared comments we had for today. I guess we're at a point now where we'd be happy to take any questions. And of course, I think we'd also invite those that on the call to go to caltrust.org, and for more information about today's topic, you can get to those white papers and seek other information regarding CalTRUST.
If you do have any questions, please feel free to enter them in the questions column on your GoToWebinar control panel. The only question I've had come through so far is if this webinar will be available for viewing and listening after today. Yes, within the next week we will have both the slides and a copy of the recorded presentation available on the resources page of the CalTRUST website. We'll give it another minute or so and see if any other questions come in. Well, it doesn't look like anyone has any questions today. I'd like to thank everyone for your participation, and especially thank you, Jeff and Kip, for presenting. Like I said, this will be available on the website. If anybody thinks of any questions, please feel free to contact me at laura@counties.org, and I'll be happy to pass them along to Jeff and Kip and get them answered. So once again, thank you, everyone, and this will conclude our webinar.
Thank you all.
Thanks.